Why don't we just go across? And if you guys can briefly introduce yourselves and your firm and what you're focused on.
Hi, everyone. I'm Jessie. I'm at Insight Partners. I focus on early growth, so think Series A through C, and I do it in all verticals. So application layer, infrastructure layer, anything AI or software.
Hey everyone, I'm Mustafa. I'm at NEA. We're a biotechnical firm investing across really every sector, stage, geography. I personally invest in two big buckets. One is the physical world, so defense, space, energy, robotics, the frontier, and then the other is software that's technical in nature, infrastructure, AI, security, and everything else.
I'm Brenton Farnioli. I'm a partner at Lightspeed Venture Partners. I co-lead healthcare for the firm, which encompasses both biotech and health tech. Health tech's my primary focus, and within that, certainly focus on AI. We invest across all stages, so seed through pre-IPO and pretty much every geography.
Cool. So let's just get a temperature check of the current environment. How active would you say your firm is now relative to normal, if there's such a thing as normal? And let's just gauge 2019 will index to like 100. And maybe if 300 is the peak and 50 is the trough of the ZERP period, where are you guys? And also, do you have to break that out separately for certain categories?
I think for us, we're probably at 1,000. We have larger funds than we did in 2019. I would say, I think maybe a couple of years ago, like AI, non-AI plays a piece with a little bit starker these days, particularly given the resurgence that's happened across the supply chain because of CapEx related to AI or certainly the reindustrialization CapEx as well. Seeing pretty much everything is seeing inflection. And really, we don't see non-AI software unless it's infrastructure, in which case it's part of the AI supply chain.
I'd actually say we're probably at 200. Insight's 300 was 2021, and I think we scarred ourselves to going back there. But we are extremely, extremely active, and our funds have grown also since 2019. So I'd say in terms of what we're looking at, we're probably at that 300. But in terms of the deals we're doing, the market's definitely gotten more competitive, and we're definitely being more selective. So probably at that 200 in terms of deal pace.
Actually, can I also just follow up just on the multi-stage question too? Because Insight's not a fund that I would historically think of as like going for Series A. So is the activity level the same across stages?
It's a great question, and I've already gotten that twice today. So Insight is multi-stage. We do everything from Series A through pre-IPO buyout. I would say our buyout team is separate from the early growth team where I spend time, and that team is definitely spending a lot less time being active. But we have interestingly been spending time in thinking about how can we AIify a lot of these companies. So whether that's portfolio companies that we spend time with, or other software companies that are looking to get efficiencies through AI. And so our buyout team has been really creative in thinking about how they're going to partner with companies in order to do that. We have some success stories there. So they're active, but definitely not as active as the A and B folks.
Yeah, I wasn't at Lightspeed in 2019, so it's hard to say relatively. I will say the firm's
You personally?
yeah, the firm's been around about 25 years and started really as an early stage fund, and so has always been quite active at the early stage, and now also have later stage funds, and so often those get the headlines, investments in Anthropic or SpaceX and other things like that. I would say, we raised $9 billion dollars in funding towards the end of last year. And that's across all vehicles, so early growth and late. And with that, we've been quite active, and part of that is everyone at the firm's more excited than ever, given what's happening with AI right now. And founder of our firm and others have been investing through cycles since 2000 and are more engaged than ever.
So I'll follow up with you, and then I'll move on to Mustafa. There's a lot of shit going on in the world right now. I mean, let's just be honest. Half of the headlines, I'm not sure whether I'm being pranked, but between energy prices, the war, maybe we'll have elections. And I'm wondering all of those factors, how do they impact, especially now somebody who's thinking about like, when should I raise? And if I don't necessarily need to raise until the end of the year, or all of that sort of stuff, are some of the macro factors impacting the way you would advise founders to say, hey, maybe you should think about doing this earlier, or maybe you should raise more because things are going to be more uncertain? Or is tech sort of weirdly insulated from this?
I would say obviously you have to worry about the market so overall to some degree, but startups you're building for 5 years from now, 7 years from now, 10 years from now. So any news cycle I would not focus too much on because that will be long gone. It's really kind of what are those tea leaves? What is being set in motion today that actually will endure in those years? And from a fundraising perspective, I think it's whatever's best for your milestones. Companies doing well and hitting milestones, it's going to raise in any environment. And obviously, if that's not the case, there might be a little bit more choreography and whatnot. But definitely, I would kind of play your game versus, well, it's summer, so I'm not going to go out to raise, or there's a war, so I'm not going to go out to raise. I would just go out when you're feeling strongest, and ideally before you really need it, because that puts you in more of a position of strength. And
So summer or war, just don't worry about either of those two things.
I'd say you can come pitch me in August.
I think in general, one of the things that's beautiful about this country is we have a gigantic pool of risk capital. When you look at the headlines of these, at least across the mega funds for the three of us, we're raising our biggest funds ever. And if we look at it relative to 10 years ago, of dollars. So I say that to say I don't think these factors really impact us at all. If anything, I think change and necessity is the mother of invention. So it often leads to reasons to start entries and reasons to fund companies. I would say just candidly though, like there probably is a way to raise capital in a way that is like your process is a little bit more efficient than it could be. So for example, if you go out in June, it probably is a little bit less efficient than if you go out in April, for example. So if you have the margin, if you can influence those things and create the right relationships. The other thing I think that works pretty well for most people is start building a relationship with folks that well ahead of your fundraise. I think for investors, if you have an ability to track you and what you beat, kind of expectation setting and then outperforming them, I think that goes a long way.
So, Jesse, I'll ask you, for folks who are thinking about, should I go and attempt an A versus padding the numbers a little bit more, getting a little extra runway, like a potential A versus a really strong one, how would you advise founders to actually think through that and whether they should consider just like extending runway and doing a little more on the milestone side?
Yeah, absolutely. It's funny because we talk about this at every single round, A, B, C. But I would say for Insight, a traditional A might look a little bit different than other folks, but we really look for A's as post product market fit. And so that means having really a couple reference customers who can speak to the software AI platform that you have built, speak very strongly to it, and that there's real market pull and that there's a real inflection in the business. And so we can see that in the numbers. We can see that in speaking with customers. And as a founder, you can feel like, hey, we've got it right. We feel that market pull. I think that's really the right time for an A, whether that's, 1 or 3 million of ARR, kind of really depends on the business. There is no ARR mark that we focus on, but telling from the market that there's a pull. And so for our portfolio companies that maybe are tweaking and trying to figure out exactly where that pull is, they feel like they're still pushing the solution into the market and there's friction. Typically, we like to do a little bit of a bridge round, give you a bit more time to really find that market pull. And so whether we're invested in the company or not, we sort of have long-term relationships with the founders where we can really give them that advice where, hey, an insider bridge round, take another $2 million because you want your A to make a splash and you don't want to raise the smallest A that the market has ever heard of. You want to make a splash. And so I do think that waiting for that pull is really important.
That's all.
I think maybe I'll give a general answer because I think there are differences in different kinds of markets. So, for example, if you're a lot of defense companies or robotics companies, the reality is like by the Series A, I completely agree with Jesse on software for sure. The reality on hard tech stuff is like you're not going to have at least like the traditional definition of product market fit and what the market says. So as a result, it's more kind of milestone based. The simple answer I would say is like ahead of fundraising, maybe even after you raise your seed round, start talking to investors and kind of laying out how you're thinking about your next set of rounds and what you're looking for and how you're thinking about what that acceleration to do. Let's say you say, let me pick anything, right? Maybe it's 10 million for your next round, maybe it's 30 million for your next round. As you approach that fundraising timeline, I actually think the best way of doing it probably is let investors almost pull you by saying, here's what I would want to see to get excited about 30 million or 20 million or 10 million or whatever it is. And if you're not feeling that pull, after you've talked to a lot of people and milestones are there, then it makes more sense to have this kind of a bridge for an extension to give you more time. But I think you should only do that if you have a very clear timeline in your head. I just think this bridge to nowhere is not a good idea. And honestly, like once you, problem is, I think you probably have a limited number of bridge bullets, at least in the capital markets, once people are kind of aware of it. So I would think of it as like, if you're going to bridge or do an extension, just make sure it gets, what you need to do. And then get going after that.
So, Brendan, let's talk about the non-metric aspect of this. I think it was last week or the week before, Ashley from Vermilion wrote this piece about that, like, round names don't matter anymore. And the way that some companies are being funded, it sort of assumes they can all have this skyrocketing growth. And some of them don't necessarily quite have it yet. Some VC firms are going earlier to compete for like the best teams or any of these other like non-traction related things. So what do you think are sort of the most important non-metric based factors that VCs are looking at?
Sure. It's a great point. I mean, everyone here is an early stage founder, and that's actually the primary component investors are looking at, right? And so who's the founder or what team have you put around yourselves? That is paramount. And so you sometimes get lost in, well, what's my growth rate and what's my burn and what's my revenue and all of this, but the founder matters a lot, and especially in terms of that founder market fit. And so those two things go together in terms of, is this a market that the investor is, has a prepared mind around, wants to make an investment in, and is this a founding team that is uniquely qualified for that, either from prior experience or generalizable experiences that come over. And I mean, the examples here are Ilia and Thinking Machines, right? Those are very large seed rounds, but extremely unique founders. So that's kind of on the one end of things. And when investors are investing in you, you come in often with, here's my projections, right? I'm going to go from 1 million to 10 million or 1 million to 5 million. Things like customers and referenceable customers and things like that breed credibility to that, but also the team behind it. If you say, I believe this team is going to do that in absence of that, if the team is very strong. And sometimes you then say, well, I need a little more data. And then, the bar gets higher and higher, depending on things, but that's where you're seeing some variability. And well, these people raised without revenue, and then this person had this much revenue and wasn't able to raise it. It's really often comes down to that market and founder within those pieces.
I just want to, before I go over to Jesse, what did you mean by prepared mind?
Yes,
Because everybody here feels like they're pretty prepared.
yeah. So I'm saying the investor has a prepared mind often.
Oh, the investor.
So often you'll come in and have a pitch and say, well, I've never thought about that space. I'm going to need, time to get up to speed, or they have already exposure into that space. And like, well, I'd rather have exposure in another trend line. And so some of that is fitting that. Jesse?
Yeah, very similar answer. I think founder market fit here is super important. And what that means to me is a lot of the times I'll have a founder come to me and be like, I worked at this industrial company and I had this like crazy pain point. And so internally at that company, I built this platform to solve it. And then I realized I could productize it and sell it to every other industrial company. Like, to me, that type of a pain point where they've experienced it themselves, they're not a founder kind of searching for a problem, they've had that problem. Oftentimes that can kind of allow Insight to lean in earlier than we typically would in a round. Outside of the founder market fit and a phenomenal team where we do lean early, we're typically looking for really strong design partners, really strong customer references. And oftentimes the great signals for us are like large enterprises working with you. They don't need to be paying you yet, but they have this problem. They want to work with you to design the solution. So oftentimes we're leaning in early and willing to get aggressive when it's really strong team and strong design partners who are speaking to this problem. We know that there's a lot of other companies out there that look just like that.
So one thing to that. I totally agree on the founder market fit. And some of you are probably sitting here saying, well, maybe I don't have the perfect founder market fit because I didn't work at X before doing something similar. And I think that's an opportunity where you can kind of create that opportunity, create that founder market fits. One is hiring teams, right? I see this in healthcare all the time where someone without any healthcare background is doing something deeply clinical or whatnot, but they hire a great chief medical officer. And so they're able to solve that in terms of now the team has that fit for the market. And others I've had where, the person's just a first principle thinker. And, there's a default no, I'm not hiring subject matter experts here because they've gotten it all wrong. I've looked at this from first principles. Here's a secret I found that no one else has found. And that can work too. And so while having a background that fits on paper, matches really well, and is kind of a tried and true, if you don't have that, you can kind of manufacture whether first principles or building the team or other things. But agree, it's a very important component. So finding a way to round that out is going to be important.
So Mustafa, I'm going to turn it over to you. A lot of founders feel like we've done the growth at all costs thing before, and occasionally VCs switch up on their opinion of that, and then founders get caught over their skis. But there are these like headline companies now that are doubling, tripling monthly, seemingly raising the bar for what VCs expect. Would love to hear your thoughts on like growth versus getting to some absolute metrics. What's a better story now? And can a founder show aggressive growth while still being like reasonably, not conservative, but rational?
I would say, I think in general, over the last few years, when this debate has come up around growth versus profitability, I think part of the issue is that people are talking about a very different set of companies. If you're a public company, obviously you couldn't be Sentinel One with a minus 100%, per cash flow margin when your growth is decelerated. But I think if you're a Series A company, I don't think a Series A company in 24 versus 23 versus 22 looked all that different, at least in terms of burn, I think growth is all that matters. Like, it's not about growth at all costs or growth at no cost. It's just that we're in the high growth business. And if you're not growing, it's not, I would say, at least in the multi-stage large venture firm, it's just tough to see a massive outcome. I think what that growth is to build very different across markets based on your customer, based on what you're going through. It's funny because I think often in the headlines, people talk about the cursors and the PLT companies that are growing really fast, but often the fastest growing companies in the world are actually the ones that are hitting, 100, 200, $500 million contracts from, for example, the federal government. So there's a lot of ways to grow really fast. It's all based on your own markets. It's really tough. I would not recommend anybody compare, a company in one market to another or yourself to something that you read in the headlines, because often the headlines have selection bias. You don't know what's got kind of underlying it. But I do think in general, growth is all that matters. What that growth is completely dependent on your market, on your stage, obviously the amount of capital you raise. It's a lot easier to grow 50x if you're burning a lot of money. But also, there are a lot of great companies that have done 50x growth, not burning that much money. They're not enterprise sales, they're not top down, they don't build a lot of R&D. I would say the unfortunate answer is it depends. But what doesn't depend is that growth matters. And I would say if you're going to prioritize marginally more profitability for much less growth, at least in the early stage private markets, that's probably always the wrong answer.
I mean, companies are growing faster now than ever before, and the data's there, the examples are there. It creates a high bar. I remember, I don't know, 5 years ago or so, it was, well, you can raise your Series A when you get to 2 million revenue. You can raise your Series A when you get to 3 million. It was a revenue bar, and so people would do a bridge, and they said, now I've hit my revenue mark. Now it's much more about growth, which is, I started the year at nothing, and now I'm at, 2 months later, I'm at 1 million. Very different than I started the year at nothing, and a year later, I'm at 1 million, as an example. The question then becomes, if many companies are growing so fast, where does this end? Because not every company can just continue growing ad infinitum. And so then the question becomes defensibility, which at the early stages is somewhat more theoretical, but having a case, whether it's around the data or the feedback loops or distribution or regulatory or just the founding team, why that growth rate is going to persist is kind of a secondary question, but kind of have to have the growth rate to earn the right to defend the defensibility of it.
So Jesse, I'm going to turn this over to you. Let's actually talk about AI just now, only once today, just in this right moment. We're not going to talk about it at any other time. Is there going to be a ceiling on these valuations, or is it still wide open? And actually, if you are, every company, every employee, every founder is like using it in some way, but that doesn't, we all have to be a little honest about like whether we're really an AI company or not. And what we hear about in the AI space artificially raise the bar for everybody else because you as an investor, you're choosing to invest in one category, or is there like just less competition for attention where there's might be some investors that are like, you know what, I'm not playing this game. I want to play elsewhere. And look, there are a handful of quality companies that I want to invest in the long term.
Yeah, absolutely. I would say Insight's actually one of those firms where every company we invest in needs some type of AI story, but we're actually not really participating in the pre-revenue rounds at $1 billion. I think, look, if you have been a co-founder of Anthropic or your company goes from 0 to 50 in its first year, you can command one of those valuations. For the other 99% of us who are building fantastic businesses with real moats, really strong teams, there is a fund out there that will want to partner with you. It's spending most of our time in actually that 99%. We think the 0 to 5 stories are fantastic growth stories, and we really want to work with those teams. And so when we think about valuation today, we're willing to stretch on an absolute lower EV basis. So what does that mean? We want to catch the company early. So if you're at 3 million of ARR and you got there in 6 months, it's a great story. Like that is an inflecting business to us. And so we'll pay 300 posts for the best in class businesses. We'll pay that 100 times ARR. But if you're at 10 million of ARR, we're going to pay $1 billion? Probably not. Like it's really hard for us once these companies kind of get away from us. I know some of my colleagues up here are probably slightly different strategies. And so I think that for that sort of 99% of business, like there are still going to be fantastic outcomes. And I think it's about working with rational, reasonable people who don't expect, their 0 to 1 story to command $1 billion. So a lot of the times we have to say no to businesses where the valuation is just unreasonable for where the company is, but we still feel really strongly that that company will be successful. And so I think that there are really different funds out there with varying different strategies, and there's a fit for everyone.
Just about, okay. I think just one thing I would add, I think we often talk about our firms like it's one monolith, but I would actually posit to you guys that I think one of the most important things for various companies is to figure out within these firms who's the right partner and fit for you. I say that because I have partners that would completely agree with Jesse and they would never invest in a pre-revenue company at $1 billion post, and then I have other partners who are doing a $250 million fund like seed round itself at $250 million, and like many of my partners would never do that. And then there are others that like that's kind of the stuff they comparatively like. And so I would say within these are partnerships often, at least with some of these firms. As a result, there's a big dispersion of what people's interests are and what they care about. I think so as a result, we really do look at all these kinds of rounds. Personally, again, partly I think because of the kind of difference in coverage areas across the firm, I think there's tons of non-AI stuff happening. But just given the CapEx we're talking about, it might be AI down the stack of the AI supply chain. For example, optical photonics. I mean, is that AI? I think probably, yeah. Otherwise, it wouldn't, people wouldn't be doing a lot of interconnect stuff. Or defense. That's probably not AI. That's another megatrend. Bookcoins. That's not AI. That's another megatrend. And that's probably one of the few megatrends in the fintech or crypto world, relatively speaking. So, there's a couple other examples of things. But there are many things. On the reindustrialization, I mean, we're looking at components, and all kinds of things.
I want to throw in a question, and then if anybody from the audience has a question they'd like to ask, we'd have a minute or two for that. Do you think it makes a pitch better or worse if founders force an AI story or, say something is AI powered, but they're just kind of using off the shelf things, like draw the line between like is core to what we do and it's an actual advantage versus just like saying you invest in internet startups, which is like, I don't know what startups anybody's doing. Like CPG is an internet startup now because we buy the thing off the web. So what do you think about the forcing of the story?
I think anytime you're putting kind of a flimsy argument together, it then hurts the credibility of the entire pitch, right? And so you want to be coming in almost teaching from a position of authority because you're spending your time all the time on this area and unearthing insights versus trying to force something which the investor actually knows more about and doesn't hold water and then is skeptical of everything else. And to some of the earlier points around getting to know the investors and vice versa, the investors getting to know you over time, having a authentic relationship conversation is kind of a harbinger to an investment because that's a very important relationship over the next decade. And so that's another part of just being tech, I think holds a lot of weight and will help. Can't help if it's just outside of a pitch where you're doing a 30-minute Zoom where you're getting coffee or getting to know someone and you can talk about why AI does not apply here or where it could and having more of a nuanced conversation like that.
Cool. Audience questions. Go ahead. Yeah, just to repeat the question, how does the panel think about defensibility in AI, especially when it used to be like, can't Google do this? And now it's like, somebody in the back is doing this now in this conference and on Lovable or wherever?
I think it's a very real, I mean, obviously this is a very important question that I think pretty much we think about with every company. I think the truth is there's probably no silver bullet. You know, a couple of years ago, people would have said, oh, go to market. Like if you're going after the world's largest enterprises and you're building new workflows with them, you know, maybe the labs won't come after you. That's just not the case, right? The chief customer officer of Anthropic was the chief customer officer of ServiceNow. Like he certainly knows every large customer that ServiceNow ever had an example. And then that goes all the way down to Cloud Code, the new DLG. And then you could say, earlier, you might have said maybe you go after a different part of the world and you do a different kind of pricing model. So I think as a result, there's no really, in my opinion, at least in the AI software part of the world, there's no silver bullet. The only thing that seemingly so far, and in the history of venture as well, has been our relative defensibility point is product velocity, retention, and growth. Is the more even Cursor, right? People will debate Cursor all day, but if you have 2 billion of revenue and you have, you know, tens of millions of customers, and you have lacquered enterprises that are now onboarding you in their long cycles, that could be defensibility, but who knows? And so I think it's there's no silver bullet. Scale is certainly the best thing that you can have. The second would be users that really love you, even if you don't have scale. So I think that's something else that we're seeing. These customer preferences are actually quite sticky. I'll give an example in our portfolio, company called Perplexity, that honestly has been, you know, people have questioned it every year for the last many years. Like, is this company going to die because of the next Claude release or the next Deep Council? And they just released their numbers and the group 5X are crushing it. And so the consistent thing, no matter what people talk about, ultimately is people love what you're doing and you have a targeted set of fans. And then you compare that with growth, compare that with retention, and compare that with scale. I think that's probably the only set of things you can have.
Yeah, only thing I'll add is I would say that there's a couple things that I'll listen for when speaking to companies. If they come to me and they say, hey, building a wrapper on top of OpenAI or Claude, it is challenging for us to invest in that. But I think there's a couple things. One is just deeply understanding your customer and building workflows that are extremely specific. There's a ton of hype around forward deployed engineers. I actually do find that companies that really embed deeply with their customers can be very, very valuable because they're doing things that other companies proprietary data, whether you're capturing that through sensors or through learned preferences with your customers, feedback loop where there's some sort of a customer relationship where they're giving feedback to the platform, it's getting smarter over time. For sharing data with you and being able to train on that data can be really valuable in more restrictive industries. And so there are a couple things we look for to determine that mode. A lot of times we are saying no to companies when they don't have an answer to any sort of defensibility. First mover advantage is no longer an advantage, you know?
I would just totally double down on that. And I also think it's interesting that that's not new, actually. And I go back to like my first job, I was on the buy side of finance and at a pension fund, and we were users of FactSet. And the person that I would call up at FactSet for service and support was a CFA who literally was probably more qualified to do my job than I was, and would very readily say, oh, like, what report are you trying to do? Do you want me to build that for you? And like, there's no world in which I would switch out FactSet for anything else based on like somebody else has a better data set or whatever. But that service and support like kept us on and was really invaluable. Cool. Thank you very much for your time. Let me give you some instructions about where you are going. So we're going to break into